Hi, this is Mr. Gideon. So now I want to talk for a few minutes about our central bank of the United States, the Federal Reserve System, also known as the Fed. There's a picture of Ben Bernanke, the chair of the Federal Reserve, or even more specifically, the chair of the Board of Governors for the Fed. And the Fed was created by the Federal Reserve Act of 1913. The act divided the country into Federal Reserve districts, and each has a Federal Reserve Bank with its own president. The boundaries are shown in this diagram. As you can see, for our district, San Francisco is the home base. You can also see in this diagram that the office for the Board of Governors is located in Washington, D.C. But our central bank was created in response to the Panic of 1907. There was a lot of financial instability in our country up until the time that the Fed was created, and so it was created to replace the national banking system that we had in existence up until that point. It was established to do a few things: to force all the deposit-taking institutions to hold adequate reserves, which many of them were not doing at that point, to open their accounts to inspection, and to make the money supply sufficiently responsive to satisfy economic conditions around the country. If you take the phrase economic health literally, then the physical health of our economic system was not consistent. And so people at that time, as as many do today, kind of equated the money supply with the blood supply, and they felt like the blood supply wasn't getting to the parts of the body in an efficient manner at the times that they were needed. And so the Fed was given the sole right to issue currency. The Board of Governors controls and coordinates the activities of the Fed. The 7 governors that serve in this on this group are appointed by the President and confirmed by the Senate to non-renewable, staggered 14-year terms. The President designates one of these board members as the chair for a 4-year renewable term. And this is one of the reasons that most people, if they know anybody that serves on the Board of Governors, know the chair, because in reality that chair can serve for several years, in fact decades, like in the case of Alan Greenspan, who preceded Ben Bernanke. The Federal Open Market Committee, or FOMC, is the major policy-making group within the Fed. It's made up of the 7 governors plus 5 presidents of Federal Reserve District banks. The president of the New York Fed has a permanent seat, and that's because the New York Fed has the responsibility of carrying out FOMC orders, particularly the buying and selling of bonds or treasuries, often T-bills. There are 8 major functions for the Federal Reserve System. The first and foremost is to conduct monetary policy by controlling the money supply, and it uses 3 tools for this. Changing the reserve requirement, which is the percentage of deposits that a bank has to hold in reserve, whether it's in their vaults or within the Federal Reserve System itself, with the Fed. They can also change the discount rate, as well as perform open market operations, which is their preferable method for conducting monetary policy. The Fed also supplies the economy with paper money, also known as Federal Reserve notes. The Federal Reserve banks have Federal Reserve notes on hand to meet the needs of banks and the public. The Fed also provides check clearing services. It's also known within this role as a banker's bank. It holds depository institutions' reserves. It supervises member banks, and it serves as the government's banker. It serves as a lender of last resort, and serves as a fiscal agent for the Treasury. The U.S. Treasury often auctions Treasury securities to help pay for the government's bills, and the Fed acts as aids the Treasury in conducting the weekly auctions. Understand there is a difference between the U.S. Treasury and the Fed. The U.S. Treasury manages the financial affairs of the government, but except for coins, does not issue money. The Fed's job is to provide a stable monetary framework for the economy. So a little bit more about these tools the Fed uses to control the money supply. As I've said, the Fed uses open market operations, the required reserve ratio, or by changing required reserves, and the discount rate to control the money supply. So first and foremost, open market operations. This is the preferred method that the Fed likes to use. It's the most flexible. It's the quickest if, for instance, they decide to make an open market purchase, which is when they go into the marketplace and buy bonds, T-bills, short-term bonds, because understand that the money supply is, when we use the phrase the money supply, we're most commonly referring to M1, the most liquid kind. We're not talking about the kinds of government bonds that have maturities of 10 or 20 years. So that's why we're kind of specific with that term T-bills usually, because that's a kind of government bond that has a short-term maturity. When they do an open market operation, they can either do a purchase or a sale. So if they have an open market purchase, that means the Fed is buying securities with money that did not quote-unquote exist prior to the transaction. They may have that in their stock, but for most purposes in this class, you need to think of the Fed as not being a part of the banking system. Think of it as the big daddy or the big mama of the banking system. It's kind of looking down and regulating the system. And yes, technically they're a bank in some respects, but we don't look at them as a bank when we do some of the calculations that are necessary to govern the answer to, how much does the money supply increase or decrease as a result of the banking system. We look at the member banks, but we don't look at the Fed. In the same respect, if they make an open market purchase, they are trying to pump money into the system, into the banks that are not, aren't serving in the same role that the Fed is. So the money exists in the hands of the Fed, but it doesn't exist in the economy per se until the Fed puts it out there, primarily through open market purchases. Now, by the same token, they can try to decrease or restrict the money supply, and that would entail an open market sale, where they once again go into the open market and they sell securities, causing bank reserves to fall and ultimately the money supply to decrease. Now, another tool is the required reserve ratio. The Fed can influence the money supply by changing it. If they, up until some point in time, said that there was a 10% reserve requirement for all banks in the Federal Reserve System, they can choose to alter that. They could say, all right, we're going to take it up to 11%, if they feel like the proper monetary policy goal should be to lower the money supply. By the same token, if they lower the required reserve ratio, let's say they change the law and they set it down to 8% now, that's the minimum that would most likely increase the money supply. Finally, the discount rate. Banks borrow funds from two major sources in order to comply with the reserve ratio. If they're temporarily not in compliance with the reserve ratio, they're okay as long as their 2-week average meets that required reserve ratio that's set down by the Fed. But to make sure that they're on target with that average, because as you can imagine, with many banks they have thousands and thousands of transactions through the course of the day, so that's why we take a two-week average. If on any one day they aren't in compliance and they know they have to get that average up, then they can borrow, typically for overnight period of time, 24 hours or less, from other member banks or from the Fed. If they borrow from the Fed, then the discount rate is the interest rate that they pay. Typically they don't want to borrow from the Fed unless they have to. There's a couple of different reasons. One is if they borrow from the Fed and instead of the other member banks, then that could signal some kind of weakness with that bank, both to the Fed or to their customers. It's something that might serve as a red flag and cause them to be looked at more closely when it comes to regulation. So many banks would prefer not to have to borrow overnight from the Fed, but if they do, then they pay the discount rate, which is a very low interest rate. Now, the other rate that we would have that would apply to these kinds of short-term loans, where one bank is borrowing from another, is the federal funds rate. So it's important to keep those two terms clear in your mind. Now, the spread between the discount rate and the federal funds rate. Even when the discount rate is lower than the federal funds rate, which is most often the case, a bank may still choose to borrow in the federal funds market for several reasons. First, as I said, the bank may know that the Fed is hesitant to extend loans to banks that want to take advantage of profit-making opportunities, but the bank may also not want to deal with the Fed bureaucracy that regulates it and trigger that bureaucracy to take a look at it, because one of the Fed's roles is to regulate. They might, the Fed that is, take this as a sign that maybe the bank's being mismanaged, particularly if they go to the Fed with some degree of frequency for overnight loans. A decrease in the discount rate compared relative to the federal funds rate increases bank borrowing from the Fed, causing reserves to rise and ultimately an increase in the money supply, and vice versa. But as I said before, the tool that the Fed prefers to use is open market operations. Open market operations allow the Fed to control the size of the transaction, and you can reverse it. Compared to the other two tools, changing the discount rate and changing the reserve requirement, this can happen much faster. And even though, like in the last year, when they've announced that they were going to try to increase the money supply by buying $600 billion worth of short-term bonds, if at some point they feel like they're on the wrong track, they can stop and even reverse course. Now, they've decided over the course of several months, as they've implemented this policy, to follow it through, see it through, but they could have changed their minds at some point. And they could have done it rather swiftly if they felt it was prudent. The Fed does not have direct control over the federal funds rate, but they influence it indirectly. And sometimes in the news you'll hear people talk about how the Fed is targeting the federal funds rate, or they plan on increasing or decreasing the federal funds rate. It's a target, or it's a goal for them, but they can't just legislate it and say, okay, at this point the federal funds rate, according to our policy, must be at a certain rate. And there are visuals that you can see that will show how sometimes the Fed doesn't hit the mark. They feel like the federal funds rate should be at a certain percentage, and they try to hit that target, but they might not be effective in making that happen. They might see, despite their efforts, a federal funds rate that's 1 or 2 percentage points higher or lower. But they try the best that they can, primarily through open market operations, to influence that, as well as to change the money supply overall.